Welcome to ZICA Academy YouTube channel. In this lecture, I want to examine planning and operational variances. Planning and operational variances arises whenever you want to correct the level of forecasting errors inherent in traditional variances. Planning variance. Planning variances are those variances which are not within the control of management. That is, they are not controllable. Variances that are not within the control of the management are said to be the planning variance. The second variance I'm going to examine is operational variances. Operational variances. Operational variances are those variances which are controllable by the management. Those variances that are controllable by the management. Planning and operational variances may be calculated for sales, it may be calculated for materials, and it may as well be calculated for labor. It may be calculated for sales, materials, and labor. When you are computing the planning variance, you want to compare the X and T. X and T. You want to compare the X and T with the X post. X and T minus X post. That is the planning variance. Planning variance, simply subtract the X post from the X and T. In computing the operational variance, I will still explain what X and T and X post mean. In computing the operational variance, you have the X post minus actual. X post minus actual. So, what do we mean by the X and T? X and T. X and T is the first target set. The first target set. That is your initial standard. Initial standard is said to be the X and T. While the latter target set is called X post. X post is your later standard, your latter standard. That is said to be the X post. Maybe you have set your standard that you want to purchase a marker and you have set 200 naira for marker. This is your standard price. You have not actually gone to markets to make the purchase of the marker. And it's not get to your awareness or to your notice that the price of a marker has risen to 250 naira. And you have not gone to the market to make the purchase. So you also alter your standard. This first standard is X and T. And why this latter standard is X post. You can have S and T standard price, you can have S and T standard quantity, you can have S and T standard hour, you can as well have for standard rate. The first standard, that is X and T, while the latter standard is X post. I want to know that both X and T and X post are standard. Remember, you've not gone to the market, but when the marker was actually purchased, you got a marker for 300 naira. This is the actual price of the marker. The X and T. Just know that both X and T and X post are used for standard. The two terms are used for standard. There is no actual among the two. So remember, I've told you that the planning variance just simply say S and T minus X post. So you can compute material price planning variance. So now let's start with material planning variance or material planning variances. Materials planning variances. Materials or material planning variances. So the first variance I'm going to examine under this is material price planning variance. Material price planning variance. Remember, I've told you in computing any of the planning variance that you are going to compare the ex ante with ex post. Therefore, you will have ex ante standard price, since it is a price variance. It's a price variance. Ex ante standard price minus, you are comparing ex ante minus ex post. So you have minus ex post standard price. When you are computing the price variance, in normal traditional variance, no material price variance, is standard price minus actual price multiplied by actual quantity purchased. So it is what you have here that determines what you have here that determines what you have here. So in planning variance also, what you have here will determine the weight you are going to have here. So that means you are going to have ex post standard. No, you don't have actual in ex post, so it will be ex post standard quantity. Remember, anytime you have standard quantity or standard hours, the two items must be multiplied by actual production. So that is why we having ex post standard quantity based on actual production. So the BOAP stands for BOAP. It means based on actual production. That is the formula for calculating the material price planning variance. Then the second variance under materials, which I'm going to examine, is material usage planning variance. Material usage planning variance. Don't forget, I've told you that planning variance is ex ante minus ex post. Therefore, material usage planning variance, no usage is talking about quantity. So you have the variance in quantity. So since planning variance is ex ante minus ex post, so you'll be having ex ante standard quantity. Remember, I've told you you have to flex your standard quantity by multiply by actual production. Ex ante standard quantity based on actual production minus, if planning is ex ante minus ex post, so you have minus ex post standard quantity based on actual production. Then the weight, remember your traditional variance, you have material usage variance, which is standard quantity based on actual production minus actual quantity multiplied by the standard price. So it is what you have here, being a quantity variance. It is what you have here that determines the weight here. So what you have here in this variance is ex ante. So you have the weight to be ex ante standard price. So you have ex ante standard price. So that is the formula for calculating the material usage planning variance. So I also want to talk about the labor rate planning variance. Now, number 3, labor rate planning variance. If planning variance is ex ante minus ex post, and you want to find the variance in rate, therefore you have ex ante standard rate minus ex post standard rate. No labor rate variance. The formula is standard rate minus actual rate multiplied by actual hours paid for. So the weight, what you have here being the price variance, it is what you have here that determines the weight. So you have the weight now to be ex post. No, you don't have actual hour for ex post for both ex ante and ex post. So the weight will be exposed standard hours. So you have based on actual production. Your standard hours or standard quantity, I've told you it must be flexed always. Number 4, you have labor efficiency planning variance. Labor efficiency planning variance. Efficiency is measured in hour. So your planning variance is S and T minus exposed. So you have S and T, since you need the hour, standard hour. I've told you your standard quantity or standard hour, you have to place it. So you have based on actual production minus, don't forget, both S and T and exposed, I've told you they are standard, minus exposed standard hours. So you have based on actual production. Multiply by, being a quantity variance, labor efficiency variance is standard hour based on actual production minus actual hours multiplied by standard rate. So being a quantity variance, it is what you have here that determines the weight. So, and what you have here is S and T. So you have multiplied by S and T standard rate. These are the formula we will examine under planning variance. Operational variances. I've told you that operational variance, you have exposed minus actual. Operational variance, I said, is exposed minus actual. So if this is operational variance, we can equally compute material price operational variance, which is being a price variance. You compare exposed standard price, your S and T and exposed, I've told you they are standard. So exposed standard price minus then actual price multiplied by, in your normal material price variance, the formula is standard price minus actual price multiplied by actual quantity purchased. So, it is what you have here that determines the weight. So, and what we have here, we equally determine the weight. So, you have actual quantity purchased. It's actual that you are going to have here. Number 2, then material usage, operational variance. Material usage, operational variance. So, your usage is talking about quantity. So, we are going to have, your operational variance is exposed minus actual. So, you have exposed standard quantity. Your S and T and exposed, they are standard. So, standard quantity based on actual production minus actual quantity multiplied by, your traditional variance, material usage variance. We say is equal to standard quantity based on actual production minus actual quantity multiplied by standard price. So what you have here, the standard quantity, standard price. So what you have here will determine the weight here. So which will be exposed standard price. That is for material usage operational variance. Then we have labor rate operational variance. If operational variance is exposed minus actual, exposed, no rate. You have exposed standard rate minus actual rate being the price variance. You have multiplied by actual hour, traditional variance. Standard labor rate variance equal to standard rate minus actual rate multiplied by actual hour. This is actual rate, actual hour. So what we have here determines. So we have actual rate, actual hour. So we don't have ex post or S&T for actual. The ex post and S&T, they are for standard. Number 4, labor efficiency, operational variance. Labor efficiency, operational variance. So which is, efficiency is ex post. So being efficiency, which is measured in hour, ex post standard hour based on actual production minus actual hours. You have ex post minus actual hours. In traditional variance, labor efficiency variance, we said the formula is standard hours based on actual production minus actual hours multiplied by standard rate. Only that your standard hours, you just replace it with ex post one. So what you have here, this is standard, this is standard. So it is what you have here that determines this. So that means you are going to have ex post standard rate. These are the formula for calculating the labor and material variances. I want to take a question as work example. Please keep watching. Example: LASICO has produced the following operating statements: reconciling budgeted and actual gross profit for the last 3 months based on actual sales of 122,000 units of its single product. Operating statement in Naira. We have the budgeted gross profit of 800,000. Budgeted fixed production overheads, 352,000. Budgeted contribution is 1,152,000. We have sales volume contribution variance, 19,200. Sales price variance, 61,000. The net difference between contribution variance and price variance is 41,800. By the time it was subtracted from the budgeted contribution, we have 1,110,200, which represents actual sales less standard variable cost of sales. We have planning variances, variable cost variances, which were classified into favorable and adverse variance. We have the direct material price, an adverse variance of 23,991. Direct material usage, a favorable variance of 42,090. Direct labor rate, an adverse variance of 81,333. Direct labor efficiency, an adverse variance of 203,350. A favorable variance is totaled 42,090, while an adverse variance is totaled 308,674. The net difference between favorable and adverse variance is 266,584. Operational variances. We have favorable variable cost variances, which is divided into favorable and adverse. Direct material price, an adverse variance of 31,086. Direct material usage, a favorable variance of 14,451. Direct labor rate, a favorable variance of 19,000, an adverse variance of 19,032. Direct labor efficiency, a favorable variance of 135,355. Favorable variance is totaled 149,806. Adverse variance totaled 51,118. 51,118. While the net difference is 99,688. Then we have actual contribution of 943,304. Budgeted fixed production overheads is 352,000. While fixed production overheads expenditure variance is 27,000. Then actual fixed production overheads is 325,000. Actual fixed production overheads 325,000. Actual gross profit 618,304. The standard direct cost and selling price applied during the 3 months period, and the actual direct labor and direct cost and selling price for the period were as follows. You have the standard and actual. Then you have the selling price, Naira per unit, 31 Naira 50 kobo. That is for standard. Actual is 31 Naira. Direct material usage, kilogram per unit, standard 3, while actual is 2 Naira 80 kobo. Direct material price, naira per kilogram, standard is 2.30, while actual is 2.46. Direct labor efficiency, hour per unit, 1.25 for standard, while actual is 1.30. Direct labor rate, naira per hour, standard 12 naira, actual 12 naira 60 kobo. After the end of the 3-month period and prior to the preparation of the above operating statement, it was decided to revise the standard cost retrospectively to take account of the following. 1, a 3% increase in direct material price per kilogram. 2, a labor rate increase of 4%. 3, the standard for labor efficiency had anticipated buying a new machine, leading to a 10% decrease in labor hours. Instead of buying a new machine, existing machines had been improved, giving an expected 5% savings in material usage required. Using the information provided, demonstrate how each planning and operational variances has been calculated. B, calculate direct labor and direct material variances based on the standard cost data applied during the 3-month period. This question is obtained from Worker Performance Management by Omolehiwa. Now let's have the solution to the question. The name of the entity is LASICO. We have LASICO, that is the name of the entity. And you have to demonstrate how these planning variances, how they have been arrived at. Let's have the solution. The name of the entity is LASICO. So, we have description. We have X and T. X and T standard. X and T standard. Then we have actual. So, if you go by the question, you have S and T. You know, the initial standard. I've told you the initial standard is called S and T. So the selling price, naira per unit, 31 naira 50 kobo, and actual 31 naira. This 31 naira 50 kobo is the initial standard, which is S and T, and this is the actual. So we have the S and T, which is selling price, which is naira per kg, naira per unit. S and T is 31 naira 50 kobo. While the actual is 31 naira. Then we also have direct material usage, kilogram per unit. The S and T is 3 naira. I've told you the initial standard is S and T, which is 3 naira, and the actual is 2 naira 80 kobo. So we have direct material usage, which is given to be in kilogram per unit. The X and T is 3.00, while the actual is 2.80. Back to the question. You have direct material price, which is naira per kilogram. The S and T is 2.30, while the actual is 2.46. Direct materials, which is in direct material price, which is given to be in naira per kilogram. Naira per kilogram. The S and T is 2.30, while the actual is 2.46. Back to the question. We have direct labor efficiency, which is given to be in hour per unit. The S and T is 1.25, while exposed and the actual is 1.30. So direct labor efficiency, direct labor efficiency, hour per unit. And the X and T is 1.25, while actual is 1.30. I've told you the initial standard is X and T. X and T. Then we have direct labor rate, naira per hour. The S and T standard is 12, while actual is 12.6. Direct labor rate, which is naira per hour. The X and T is 12, while actual is 12.60. Then the next thing, we want to calculate the X post standard. X post standard. I've told you the latter target set is called X post. The latter standard. The standard that was later altered, that is X post standard. Now, back to the additional information. After the end of the 3-month period and prior to the preparation of the above operating statement, it was decided to revise the standard cost retrospectively to take account of the following. 1, a 3% increase in the direct material price per kilogram. If the price per kilogram of material would increase by 3%, that means the initial standard will need to be altered to cater for the 3% increase. So that when you alter the original standard, then you arrive at the latter standard, which is X post. Now, 3% increase in direct material. Now, in direct material price, no, it is the price per kilogram you want to increase. Now, let's increase the direct material price. So this is direct material usage. That is not the one to increase. Direct material price. The initial price was 2.3. If you increase it by 3%, which is, if you add 3 to 100, it will give you 103. Then 103 divided by 100, it will be 1.03 times 2.3. So that means our latter standard price now, 1.03 times 1.03 times 2.30. That gives us 2.369. Therefore, the expo standard price of direct materials is 2.369. Now, back to the question. Now, 2. A labor rate increase of 4%. It is the labor rate you want to increase by 4% now. And how much? Now, go back to the question. This is direct labor efficiency. Efficiency is not the same as rate. Direct labor rate. So, it is the rate you want to increase by 4%. Initial S and T standard rate is 12 naira. If it increases by 4%, if you add 4 to 100, you have 104. 104 divided by 100, it will be 1.04 times 12 naira. 12.00. Therefore, expo standard direct labor rate will be 1.04 times 12. That gives us 12.48. 12.48. Therefore, the expo direct labor rate is 12.48. Back to the question. Note 3. You were told that the standard for labor efficiency had anticipated buying a new machine leading A new machine leading to a 10% decrease in labor hours. 10% decrease in labor hours. No, this is an efficiency of labor. An efficiency of labor is the ability of labor to increase greater productivity or to increase the output, or an ability of labor to lead to a greater productivity without actually increase the quantity of labor itself. Now, if the efficiency of labor will decrease by 10%, efficiency, what is our labor efficiency? Direct labor efficiency. That means the actual efficiency attained, if you subtract 10% from 100% minus 10%, that will be 90%. The actual efficiency attained is 90%. What will now be the exposed standard efficiency hour? So you have 1.25 because the S&T is 1.25. You now divide this. That means you want to convert this one to 100. If this is equivalent to 90%, 1.25 is 90%. That is, it is the same as having 1.25 times 100 divided by 90. That is what you want to do. You want to gross it up, not calculating 90% of it. So divided by 0.9. So 1.25 divided by 0.9. That gives us, we have exposed standard hour 1.3889. That is, if you have 1.25 times 100, 1.25 times 100 divided by 90, that gives us 1.3889. So which is the same as where the result obtained when you divide 1.25 by 0.9. So it's 0.9. So that gives us 1.3889. Back to the question. You were told, instead of buying a new machine, an existing machine had been improved, giving an expected 5% savings in material usage. Savings. Material usage, less of materials will be used. So instead of using 100, we will now use 95% in material. Now, what is material usage before? We're using 3. So if 5% will be saved, subtract 5 from 100, then you'll be left with 95%. That is 100 minus that 5% that will be saved from no 3 times 3.00. So 3 times 95%, that gives us 2.85. Therefore, exposed standard direct material usage is 2.85. Now, required, using the information provided, demonstrate how each planning and operational variances has been calculated. We want to demonstrate how we've arrived at the following planning variances. The first planning variance we have is direct material price planning variance. We want to demonstrate how they've arrived at this 23,991. So now, direct material price planning variance. And we said this is X. In planning variance, we want to compare the S and T with exposed. So we have X and T, standard price minus exposed standard price. And I've told you what you have here determines what you are going to have here as a weight. Since you compare price, then the weight should be quantity. So that means we are going to have exposed standard quantity. Exposed standard quantity based on actual production. Now, back to the question. Our ex ante standard price, from our previous solution, ex ante standard price is 2.3. while ex post standard price is 2.369. Then what is ex post standard quantity based on actual production? We want to determine ex post standard quantity based on actual production. Now, our ex post standard quantity. Notice the direct material usage. Therefore, ex post standard quantity is 2.85. 2.85 times what is the actual production? Now, if you go back here, you were given based on actual sales of 122,000 units. You were not given the units produced. It is assumed that the number of units produced is what was sold during the period. Therefore, production and sales are the same in this question. But where the number of units produced is different from the number of units sold, you use the units produced. But we are assuming 122,000 units were produced since the number of units produced were not given. So actual production is 122,000. So you have what times 122,000. Therefore, 2.85 times 122,000. Therefore, ex post standard quantity based on actual production, and that is 347,700, and the unit is kg. So that is for direct material, because direct material usage is given in kg per unit. So that is why I have the SI unit to be in kilogram. Now, in that case now, what is the ex-ante standard price? Ex-ante standard price, ex-ante standard price is 2.30. And ex post standard price is 2.369. Therefore, we have 2.30 minus ex post 2.369. This is ex ante. And I've told you the formula is ex ante standard price. And ex ante standard price is 2.30 minus ex post standard price, which is 2.369, multiplied by the ex post standard quantity based on actual production. And the ex post standard quantity based on actual production has been determined. And we got 347,700 kg. So the difference between this and this, 2.30 minus 2.369, the difference is 0.069 times 347,700. So we have 23,000. You must put your naira, your currency, 23,991. The the latter price is greater than initial price. You plan to buy it, to buy a unit, a kg of material for 2.3, and when it got to your awareness that the price has risen, you will alter your latter price to 2.369. This latter price is greater than initial price. So that means it is an adverse variance. That is direct material price planning variance. 23,991 adverse. Let's compare this figure with the amount given in the question to see if they tally. Yes, in our question, you were given the direct material price of 23,991, which is the same with the result obtained. So that is correct. Then you want to confirm how they vary a direct material usage variance. Direct material usage planning variance. Direct material usage planning variance. For usage, it's talking about the quantity used in production. And remember, in planning variance, you are comparing the ex ante with ex post. Therefore, you have ex ante. No, it is quantity we want to compare. So ex ante standard quantity based on actual production minus, we are comparing ex ante with ex post. Ex post standard quantity based on actual production multiply by, for quantity, this determines the weight. So multiply by, and what you have here is S and T. You have S and T standard price. Now, what is the ex ante standard quantity? We've gotten the exposed standard quantity here. Exposed standard quantity has been calculated here. So what will now be the ex ante standard quantity? Ex ante standard quantity based on actual production. So ex ante, we're given direct material usage. Ex ante standard quantity is 3 kilogram per unit. So we have 3 based on actual production, and we said the unit sold is the unit produced, 122,000. So 3 times 122,000. Then you have 366,000, 366,000 kg. So ex ante standard quantity, that is 366,000 minus exposed standard quantity. Our exposed standard quantity based on actual production, that is 347,700 minus 347,700 multiplied by exposed standard price. Now, our exposed standard price, this is direct material price. This is S and T standard price. Sorry, we have X and T standard price here as the weight. So here, this is direct material price. This is S and T, and why this is exposed. So our S and T standard price is 230 kobo. So we multiply by 2.30. Therefore, direct material usage planning variance equals to, you have to put your naira. So 366,000 minus 347,700, 347,700. The difference is 18,300. 18,300 times 2.3 times 2.3. So you have 42,090. 42,090. Is this favorable or adverse? You plan to use 366,000. You did use 347. So this is greater than this. Less is used. That is to show that this is a favorable variance. This is favorable. So now let's compare it with the figure given in the question. You have direct material usage planning variance, which is a favorable variance of 42,090, which agrees with the figure given in the question. Now, the next item we want to compute is direct labor rate planning variance. Let's compute direct labor rate planning variance. We want to compute direct labor rate planning variance. So, which is S and T standard rate minus exposed standard rate multiplied by, so it is what you have here that determine the weight. You want to use, since you are finding the difference in rate, the weight should be in hour. So we have exposed. If it is quantity variance, it is what you have here that determine the weight. So here you have exposed standard hours based on actual production. You've determined, or you already have S and T standard rate and exposed standard rate. Back to this table. This is the standard rate. This is S and T, and this is S post. Then we are left with S post standard hour based on actual production. What is S post standard hour? S post standard hour based on actual production. So our X post standard hour, this is direct labor efficiency. This is S and T. This is X post 1.3889. 1.3889 based on actual production. Remember, we use quantity sold as our production, 122,000. So that gives us 1.3889 times 122,000. So we have 169,446. 169,445.8 hours. This is S post standard hour. Now let's substitute into this formula. S and T standard rate. This is the labor rate. S and T 12 naira minus S post standard rate. S post is 12.48. 12.48 multiplied by S post standard hour based on actual production, which is 169,445.8 hours. So what is the difference between this? 0.48. 12 minus 12.48. The difference is 0.48 times 169,445.8. So we have 81,333. Therefore, direct labor rate planning variance equals to 81,333. So this is an adverse because this is greater than this. So it's an adverse variance. 81,333. Now let's compare it with the figure given. So it is correct. It's 1,333. The last one under planning variance is direct labor efficiency variance. How they vary by 203,350. So direct labor efficiency planning variance. So efficiency is measured in hour, which is X and T. You know, planning variance, you are comparing S and T with S post. S and T standard hour based on actual production minus X post standard hour based on actual production. Remember, I've told you both S and T and S post. I've told you they are standard. There's no actual in S and T and S post. Now that you compare this and this, because it is quantity variance, so it is what you have here that determine the weight. So that means the weight will be S and T standard rate since you compare hours. So we have weight as rate, S and T standard rate. Now, you have calculated your exposed standard hour. You've already know your S and T standard rate. So we need S and T standard hour. Let's calculate S and T standard hour based on actual production. So what is our S and T standard hour? 1.25. So we have 1.25. Our production is taken to be 122,000, which is units sold. I've told you why units sold is assumed to be the same as units produced. I've told you they are assumed to be the same since we are not given production and we are not given inventory, anything that is left in inventory. 152,500. That is hours. If something is left in inventory, you are going to add your closing inventory to sales to get your production. And if you're equally given the opening inventory, that means the budgeted production will be, your production will be sales plus closing inventory minus opening inventory. So we've determined the S&T standard hour to be 152,500. So this is 152,500. 152,500 minus exposed standard hour. Our exposed standard hour based on actual production, and that is 169,445.8. 169,445.8 multiplied by S&T standard rate. Our S&T standard rate is 12 naira. Multiplied by 12 naira. So 152,500 minus 169,445.8. That gives us 16,945.8 times 12. So you have 203,350 approximately. Therefore, direct labor efficiency, planning variance, that is equals to 203,350 adverse. So let's compare it with what we were given in the question. We were given 203,350. So it agrees. That is how they've arrived at those planning variances. The next one is how they've arrived at the operational variances. We want to demonstrate how the following operational variances have been arrived at. The first operational variance we are going to examine is direct material price operational variance. How they've arrived at this 31,086. Now let's compute direct material price operational variances. Operational variance. Now operational variances. So the first operational variance we are going to examine is direct material price operational variance. Remember, I've told you that in operational variance, you want to compare the exposed with actual. Therefore, you have the exposed standard price, since it is price variance, exposed standard price minus actual price multiplied by, I've told you in price variance, it is the weight here that it is what you have here that determines the weight. Since it is actual you have here, that means you are going to have actual quantity purchased. So, you've known your exposed direct material price, you've known the exposed standard price, then you've equally know your actual. So we are left with the actual quantity purchased. Actual quantity purchased, which is, you are given the actual quantity here to be 2.8. So actual 2.8. So we have 2.8 times 122,000. 2.8 times 122,000. That gives us 341,600 kg. That is the actual quantity of material purchase. Therefore, to compute the direct material price operational variance, and we said this is exposed standard price. And how much is our exposed standard price? Direct material price Expose is 2.46. Sorry, 2.369. That is expose standard price. Expose standard price 2.369. And our actual price is 2.46. So expose standard price is 2.369 minus actual price, which is 2.46, multiplied by the weight, which is the actual quantity purchased as determined, and that is 341,600. 341,600. So what is the net difference between this and this? 2.369 minus 2.46. Then the difference is 0.091 times 341,600. That gives us 31,086 approximately. So we have 31,086. This is greater, so it is an adverse variance. If you compare this with the figure given in the question, you discover both agree as 31,086. Then the next one is, since this is correct, let's proceed to the next one. Direct material usage variance, operational variance. We have 14,451. How they arrive at this? That is what we need. Direct material usage operational variance. So direct material usage operational variance. Remember, in operational variance, you want to compare the exposed with actual. So we have exposed. No, since it is usage, exposed material usage quantity, exposed standard quantity based on actual production, minus compare exposed with actual. So we have actual quantity multiplied by what you have here, determine the weight in terms of quantity variance. So we have X post standard rate and standard price. Since you are comparing quantity, the weight must be in price. Expose standard price. So expose standard quantity. Expose standard quantity. So the quantity we have determined here is actual quantity. So this is no. So we need this one now. Exposed standard quantity. Exposed standard quantity based on actual production. And how much is our exposed standard quantity for direct material usage? This is X and T. Standard quantity. And this is exposed 2.8. So we have 2.8. 2.8 times 122,000. That gives us 2.8 times 122,000. So we have 341,600. 341,600. Exposed. Sorry. The exposed, this is actual. Actual is 2.8, not exposed. Exposed is 2.85, so not 2.8. So 2.85 times 122,000. 2.85 times 122,000. That gives us 347,700 kg. Now let's substitute into the formula. Exposed standard quantity based on actual production, that is 347,700 minus actual quantity. Actual quantity as determined. Actual quantity purchased 341,600. Should even be actual quantity used here. 341,600. The quantity purchased and quantity used will be the same. So since there are nothing left in inventory, exposed standard price And our ex-post standard price, 2.369. 2.369. So 347,700 minus 341,600. We have the difference of 6,100 times 2.369. So we have 14,451. 14,000. We have 14,451. So this is greater than this. So it is a favorable variance. A favorable variance. That is direct material usage operational variance. Now, back to the question. So we've gotten this. The next variance is direct labor rate. How they've arrived at 19,032. That is what we want to determine. 3. We have direct labor rate operational variance. Remember, operational variance, we want to compare ex-post with actual. That will be ex-post, since it is rate variance. So standard rate minus actual rate. What you have here will determine the weight multiplied by actual hours. The weight should be hours. So actual hours. Now, we've not know our actual hour. So actual hours, that will be, go back to the question, direct labor efficiency. This is S and T. This is actual. This is ex-post. Therefore, actual hour 1.3. 1.30 times 122,000. That gives us 1.3 times 122,000. So we have 158,600 hours. So, substituting into the formula, our ex-post standard rate comparing with actual rate. So what is the ex-post standard rate? This is S and T standard rate. This is actual rate. And the ex-post is 12.48. Comparing this with this, we have 12.48 minus actual rate, which is 12.60, multiplied by actual hour, which is 158,600 hours. Therefore, direct labor rate operational variance, that will be 12.48 minus 12.6. You have 0.12 times 158,600. So we have 19,032. 19,032. So this is greater than this. That is an adverse variance. Adverse variance. So if you check the figure given in the question, it tallies with that. So it agrees with that. That is to show that it is correct. So the last operational variance we want to examine is direct labor efficiency operational variance. How they arrive at 135,355. Direct labor, number 4. Direct labor efficiency operational variance, which is X post standard hour based on actual production. Remember your standard, I have said you have to flex it. minus actual hour. Because you are comparing the exposed with actual, the weight will be standard rate. So which standard rate? What's here? You have here determine what to use. So you have exposed standard rate. Exposed standard rate. So as calculated, you've calculated the actual hour here to be 158,600. You are left with exposed standard hour. So exposed standard hour based on actual production. What is our exposed standard hour? So the S and T, this is S and T, this is actual, this is exposed 1.3889. 1.3889 times actual production of 122,000. So 1.3889 times 122,000. So we have 169,445.8 hours. Now substituting to the formula, exposed standard hour, that is as determined 169,445.8 minus actual hour as determined earlier. Actual hour 158,600. 158,600 multiplied by exposed standard rate. How much is our exposed standard rate? Direct labor rate. This is S and T. This is actual, and exposed is 12.48. So we have multiplied by 12.48 naira. So we have, if you say 169,445.8 minus 158,600, you have 10,845.8 times 12.48. That gives us 135,000. Therefore, direct labor efficiency, operational variance. We have 135,355. 135,355. This is greater than this, so it is a favorable variance. Favorable variance. Now, and that agrees with this. So we have shown how they've arrived at the individual planning and operational variance. That is the first part of the question. B, calculate direct labor and direct material variances based on the standard cost data applied during the 3-month period. So you want to calculate the direct labor and direct material variances. We can compute direct labor cost variance, labor rate variance, and labor efficiency variance based on the information provided. Now, direct labor variances. Direct labor variances. Remember, direct labor, we have direct labor cost variance, labor cost variance, which is standard cost minus actual cost. Remember, the standard cost is the same as standard hours times standard rate, while actual cost is the same as actual hours times actual rate. So now, we want to determine the direct labor cost variance. You go back to the table. Your S and T is what you are going to use as your standard. You don't need exposed here. What you need is S and T. So as your standard. So the standard hour for direct labor now. This is direct labor. The standard hour is 1.25. We used to flex our standard based on actual production. So that means our standard hours based on actual production, that will be standard hours based on actual production. That will be 1.25 times 122,000. So that gives us we have 152,500 hours. Then actual hours too. Actual hours. So our actual hours direct labor 1.3. So 1.3 times 122,000. 1.3 times 122,000. So that gives us 158,600 hours. So standard hour times standard rate. Standard hour, that is 152,500 times standard rate. And the standard rate is 12 naira minus actual hour times actual rate. Actual hour is 158,600 times actual rate. Actual rate. And our actual rate is 12 naira 60 kobo. 12 naira 60 kobo. So what is the product of this? 152,500 times 12. So we have 1,830,000 minus 158,600 times 12.6. So we have 1,998,360. So what is the difference between this and this? So you have 168,360. Therefore, direct labor cost variance that amounted to 168,360 adverse. Remember, direct labor cost variance will be divided into direct labor rate variance and direct labor efficiency variance. Now let's compute direct labor rate variance, which is equal to standard rate minus actual rate multiplied by actual hours. Now, the standard rate, direct labor rate, standard rate 12 naira, actual rate 12 naira 60 kobo. So we have 12 minus 12.60 multiplied by actual hour. Actual hours determined is 158,600. 158,600. So, therefore, direct labor rate variance that amounted to 12 minus 12.6, that will be 0.6 times 12 minus 12.6, that is 0.6 times 158,600. 158,600. So you have 95,160. 95,160. This is greater than this, so it shows that it is an adverse variance. That is direct labor rate variance, an adverse variance. Then we can also compute the direct labor efficiency variance. Number 3, direct labor efficiency variance. which is equals to standard hours based on actual production minus actual hours multiplied by standard rate. So we've computed our standard hours based on actual production, and we got 152,500, and actual hour, that is 158,600. So we have 152,500, 152,500 minus 158,600 multiplied by standard rate. And our standard rate, direct labor, 12 naira. So we multiply it by 12 naira. So we have 152,500 minus 158,600. We have 6,100 times 12. That gives us 73,200 adverse. That is direct labor efficiency variance. If you add this adverse plus labor rate variance adverse, the sum of the two, 95,160. There you have 168,360, which agrees with direct labor cost variance. That is for direct labor. Then the next variances we have is for materials. We can compute the material cost variance, material price variance, and material usage variance. So we have material variances. I've told you those variances we can compute with regards to materials, include materials cost variance. The variance you can compute as regards to materials include material cost variance, which is standard cost minus actual cost, standard material cost and actual material cost. And I've told you the standard cost is standard quantity based on actual production times standard price, while actual cost is actual quantity times actual price. So what is our standard quantity based on actual production? Standard quantity based on actual production. Back to the first table. For material, direct material usage, we have 3 kg per unit. 3 times, remember we've assumed actual production to be 122,000 units, which is the number of units sold. 3 times 122,000, that gives us 366,000 kg. Then we equally need actual quantity. Actual quantity. So if you go back to the table where you have actual direct material usage, actual, you have 2.8. 2.8 times 122,000 as well. That gives us 2.8 times 122,000. So we have 341,600 kg. Therefore, material cost variance. Material cost variance, we said it is equals to the standard quantity based on actual production and standard price. And our standard quantity based on actual production, that is 366,000 kg. 366,000 times standard price. And our standard price for material, the standard price is 2.3. So 2.3 minus actual quantity. And our actual quantity is 341,600. 341,600 times actual price. Actual price is 2.46 from the table under the actual column, 2.46. So we have 2.46. So 366,000 times 2.3, that gives us 841,800. 841,800 minus 341,600 times 2.46. So we have 840,336. What is the difference between the two amounts? 841,800. So you have the difference of 1,464. Therefore, direct material cost variance amounted to 1,464. This is greater. It shows that it is a favorable variance. Then you can as well compute direct material price variance. Direct material price variance, which is standard price minus actual price multiplied by actual quantity purchased. The standard price from the table, direct material price. The standard price is 2.30. Actual price is 2.46. So 2.30 minus 2.46 multiplied by actual quantity purchased. And that actual have been calculated. And we got 341,600 kg. 341,600 kg. Therefore, what is the difference between this and this? 2.3 minus 2.46. We have 0.16 times 341,600. So you have 54,656. So, therefore, direct material price variance amounted to 54,656. 656. This is greater, so it's an adverse variance. Then you can equally calculate the direct material usage variance. Direct material usage variance. And I've told you that would be equal to the standard quantity based on actual production minus the actual quantity multiplied by the standard price. Now, as determined earlier, the standard quantity based on actual production, that is 366,000. And our actual quantity is 341,600. So now let's have 366,000 minus 341,600 multiplied by the standard price. And what is the standard price of direct material? You have direct material price 2.30. So multiply by 2.30. 2.30. So what is the difference between this and this? 366,000 minus 341,600. You have 24,400 times 2.3. Then you have 56,120. Therefore, direct material usage variance amounted to 56,120 naira. This is greater than this. So it shows that it is a favorable variance. If you add the material usage variance and the direct material price variance, the sum of the two will give you the direct material cost variance. This marks the end of the solution to the question. Please don't forget to drop the love emoji. Also like the video and share it with others. Thanks for watching ZICA.